Welcome to Richard Suttmeyer's 4 and 4. 4 blips on my radar screen presented in 4 minutes or less. A year ago, the regulators, economists, and Wall Street strategists said that the subprime issues were isolated. I said subprime was the tip of the iceberg. Alan Abelson, in his Great Fall column in today's Barron's, described how Goldilocks economy is metamorphosing into the Humpty Dumpty economy. I have been tracking this change for almost 2 years now. My first blip looks at why I became concerned about community and regional banks. It was March 2006 when I read an article in the business section of the St. Petersburg Times. The article was the first I saw that covered the overbuilding of new homes from Tampa Bay to Naples, Florida, and how community banks were overexposed to construction and development loans. I was amazed to learn that the average price of a home in Southwest Florida was going up by more than $300 per day, which to me was the inflating of a used housing bubble on steroids. After chatting with the St. Pete Times reporter, I contacted the FDIC and began to learn how to read their quarterly banking profile. My second blip describes my early columns covering exposures to C&D loans. In one column, I listed 50 community and regional banks, calling them dominoes, and predicted that their share prices would fall in the months ahead. A year ago, when subprime mess became headline news, the so-called experts kept calling them contained and that there would be no contagion. I strongly disagreed in my writings. On March 1st, 2007, I published Goldilocks is Getting Wrinkles in a Right Side special report. I predicted that the U.S. economy would be in recession in 2008-2009 and that the U.S. stock market would begin a bear market that would last right through the 2008 presidential election. I said that I would not be surprised if GDP in current dollar terms would be lower in 2009 than in 2008. This happened very infrequently. 1929 to 1933, 1945 to 1946, and 1948 to 1949. My third blip was my forecast last September, beware of the Ides of October. As the Federal Reserve began cutting the federal funds rate beginning in September, I reiterated my call that 2007 would mark the beginning of a bear market for stocks. The catalyst would be miserable earnings from community and regional banks, which would report in mid-October. Dow Theory finally confirmed the bear market the day before Thanksgiving. The experts said that rate cuts were positive for financials. I said lower rates would not make bad loans solvent. My fourth blip reiterates that the economy is like Humpty Dumpty, ready to take a fall. The Treasury Secretary pushes voluntary programs to help borrowers while foreclosures outpace home sales and property values plunge. The Federal Reserve continues to cut rates, ignoring the risk of inflation, and watches the dollar take the dive. The FDIC reported that net income in the banking system plunged nearly 80% sequentially in Q4 2007, yet the FDIC chair tells us that the financial industry is well capitalized to withstand a few bank failures. I have many special ideas on how to ease the pain, but a solution will take years, not quick fixes. I would love to present my ideas, but the politicians are just not ready to listen. Yes, it is a Humpty Dumpty economy ready to fall into recession. I explained this in detail in my February 28th 4 and 4 and on Fox Business a week ago today. Send your comments and questions to support@rightsideadvisors.com. That's today's 4 and 4. Enjoy your day.